Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, I'm joined by Dave Gill, our Portfolio Manager, responsible for our industrial and tech sectors. Welcome to the show, Dave.
Good afternoon, Mike.
Great to have you on the show. So, we want to get an update in terms of what's been happening in industrials and technologies. So we always like to start from a business perspective, the business results. So how have the two, call them the subsectors, been faring?
Yeah, I think if you haven't really been paying attention and maybe just zoom out, you'd look at the performance on a year-to-date basis, and you'd probably think that things were pretty normal from a return perspective and a business performance perspective. But it's really been a tale of two markets, Mike. For most sectors, including the information technology and industrial sectors. We basically saw a risk-off environment into Liberation Day as investors questioned whether this was an ideological shift or a negotiation strategy. Then we saw a risk-on phase after investors got their answer early in April, which essentially took the worst outcome off the table, at least for now. IT and industrials are generally more economically sensitive sectors, as you know. So when the macro deteriorates, they generally lag. In addition to that, when we examine the fundamentals of the sector, so things like valuation, earnings growth, profitability, or the price you pay and the what you get, these sectors looked less favorable from our perspective, particularly on valuation. Also, for the industrial sector, we thought that expectations for calendar year 2025 on the revenue and earnings line looked a bit optimistic, particularly when one considers the macro backdrop. I think incrementally, however, we've become more positive as more recently we've seen the information technology sector lagging the broader market, which has improved its relative valuation. And then from the industrials side of things, we've seen revenue and earnings expectations come down over the last quarter or two to much more reasonable levels, which is also a net positive.
Okay, and a net positive, again, you're looking at it more from call it the buy side, investment side, things becoming maybe a little more reasonable.
Exactly. Investors or the market generally has expectations for how these businesses are performing. And while business results may be good overall, they may not be up to the level of expectation of the market. And in that case, they're likely to disappoint.
Okay. So you mentioned, and, why don't we talk about then, and you mixed it in there a little bit, but a little bit more in terms of the market reaction then,
Sure.
In terms of some of these results and what we're seeing.
Yeah, well, our focus obviously is mostly on business performance, like you've talked about, and I think all things considered, our core picks are performing quite well despite a difficult operating environment. On average, when I look at the names that I cover, they beat expectations both on the top and bottom lines. And those results were actually in line to slightly better than the overall market. So that's a good thing. That's something that we want to see. Only a few companies, so call it a handful of companies, saw negative share price reactions to their earnings reports. But those reactions overall, Mike, were relatively muted. They were more related to a lack of guidance or clarity, disclosure, whatever you want to call it, regarding tariff or DOGE impacts on the business rather than actual operational missteps or a lack of execution. So I think that that generally or potentially highlights one of the key components of TriCert's value proposition, and it's something that you've talked about at length over the last little while, and that's our philosophy on investing in quality businesses for the long term. The companies that I look at in industrials and IT not only have strong management teams, solid prospects for growth, or the opportunity to increase profitability, but they also have strong balance sheets. So they're able to weather the storm. In addition to that, based on my analysis in information technology and in industrials, the type of companies that we look at, generally speaking, they're better prepared, in my opinion, for today's challenges than ever before. Because if you look back to 2008, these management teams have really faced a rolling series of crises. And so when you face a rolling series of crises, you get a dress rehearsal. And each dress rehearsal, you get a little bit better and a little bit better. And that's where these companies are right now in this challenging environment. These management teams are also much more agile, and they're focusing on controlling the controllables. So that's leading to better execution overall. In addition, when we look at what these companies have done and how they've responded to the environment that we're in currently, remember, this administration was in place in 2016 to 2020, so they had a runway and an opportunity to prepare for what's ahead. And so these teams have diversified their end markets and their revenue streams and have solidified their relationships with both customers and suppliers. So you feel pretty good about where these companies are and how they're positioned. Beyond all that, they've undertaken great lengths and made great investments in supply chain optimization, so they're able to respond more quickly. Certainly there's been some clarity with regards to the trade and tariff backdrop, but we're sort of not out of the woods yet. And then finally, what I would say is that a lot of these companies that I look at, particularly in the industrials sector, if you look at their manufacturing footprints, they've tried to diversify those manufacturing footprints and give them more optionality. And then on top of all of that, during COVID, when the revenue line sort of disappeared, these companies paid a lot of focus to the expense line, and so they became much more efficient operators. Now, just on that point, if I think back to our last time we spoke, we talked about one of our core picks in the industrial sector, and that company was John Deere. So a farm equipment manufacturer, great quality company. In fact, stock's done very well since we spoke. But nonetheless, one of the reasons they've done so well since we spoke is that they provided a lot of disclosure, which is obviously welcomed by the investment community with their most recent earnings report. And I think I talked about, really what's been driving that stock is a deterioration in farm fundamentals and just demand for farm equipment, which has basically dropped 20% year over year. But having said all of that, they provided disclosure on some of the things that I just talked about, these hallmarks of quality companies. And one of the things that they talked about is that, their end markets are actually more levered towards the U.S. In fact, 80% of finished goods and I believe about 75% of components for their equipment are actually sourced in America and built by Americans. So in my opinion, one of the reasons that stock has moved higher is not just sort of improving sentiment overall in farm fundamentals and then ultimately demand for farm equipment, but this whole tariff cloud has been lifted because of management disclosure, which again is welcomed.
That's good to see that they're well positioned. And any special call outs in terms of, you mentioned John Deere from last quarter, maybe this quarter, anybody you want to highlight and dive deeper into in terms of what they've done?
Yeah, absolutely. I think maybe we'll shift over to the information technology sector. Again, last time we spoke about industrials, I circled back on Deere, and that's not to say that there aren't some good candidates and quality companies on the investment tech and the information technology sector side as well. And one of the companies that I'd like to highlight, just because it's really indicative of what's kind of been going on in the market more broadly, and that is Microsoft. So if you look in the last few months, we've seen 2 quarterly reports come out of this company, their fiscal year 2025 Q2 and Q3 reports. Both reports, Mike, were solid for both the top line and the bottom line. So revenue was better and earnings were better. But after the second quarter report, the stock sold off sharply. Their Azure business, which is basically their cloud platform and related services, was light versus expectations. I think we talked about that a little bit earlier. Sometimes the actual results aren't what drives the stock. It's the expectations or the whisper numbers regarding those results, which is more important in the short term. But that business, so Microsoft's Azure business or cloud platform business, was already benefiting from on-premise to cloud migration, which basically helps clients lower IT costs, increase scalability, enhance security, etc. But now there was an additional revenue tailwind coming from AI, or an increase in AI related workloads. When we look at that business, it's got obviously a lot of runway for growth, and that's something that investors are paying a lot of attention to. Microsoft itself has stated its intention to integrate and to scale the power of AI across its data and tech stack. I think you'll remember they made their initial investment in OpenAI back in 2019, a very large subsequent investment in 2023, which was really a watershed moment for AI, because it led to sort of broad acceptance or commercialization of AI, and basically has created this inertia that we're seeing in the information technology space since then. Regardless, most of us would see this AI like on a day-to-day basis. You come into work, you open up Microsoft 365 and you see Copilot. That's Microsoft working this AI across its data and tech stack. It's also in other product categories. Of course, Microsoft's a huge company. It's got several very deep and broad product offering. So they have AI copilots in search, security, cloud, and then software development tools that you're likely familiar with, like GitHub. Needless to say, to prepare for this AI demand tailwind, Microsoft has had to invest. And if you look at their capital expenditures from 2021 to 2023, they ran at about, call it $20 billion a year. Right now, Microsoft is spending roughly that a quarter.
Oh, wow. Yeah, I didn't realize it had jumped that much.
It has, and they're spending that on both short-lived assets and long-lived assets. So short-lived assets, we're talking about GPUs, CPUs, so these high-performing chips, servers, things like that. Call it the stuff that goes inside of these data centers, and then the actual brick and mortar, the data centers themselves, more long-lived assets. So their CapEx, or the amount of money that they're spending to support that future demand, is ramped up materially. And so the investment controversy right now, what investors are paying attention to, is like, are we going to get a return on that investment? And when is it coming? And is it going to justify the cost? And I think if you look at Microsoft, it's done a great job so far at managing its cost of goods sold and its operating expenses, because if you look at their margins, they've actually been able to maintain their margins in light of this significant investment cycle. This is a company that gets, call it high 60% gross margins and mid 40% operating margins. So it's a very, very profitable company, and they're doing all of this while capital expenditures have gone up from, call it a run rate of $20 billion a year to about $80 billion a year. Quite impressive results. But nonetheless, the stock still sold off after the Q2 results. Now, the point I'm trying to make is that the market can be impatient at times. And I know one of your mantras has been, we're not traders, we're investors. And, to that end, the Q2 miss on Asia didn't change our view, because we're not so myopic. We're thinking about the long term. We want to hold these good businesses over long time periods. And that's what we continue to do with Microsoft. And of course, how this story ends is that they reported their Q3 results not that long ago, and they flipped the script. Asia beat expectations, moving the stock significantly higher and showing that the AI monetization story is still very much intact. In fact, I think the company has said that the aggregate revenue run rate for AI-related business is now north of $13 billion on an annual basis, which makes it the fastest growing business to reach that milestone in the company's history. And again, when you consider some of these legendary products and the depth and breadth of the product portfolio at Microsoft, that's pretty impressive. And it's a story that we continue to like.
I got to tell you, before recording this podcast, I literally just came back from a meeting with our tech folks, and we're along a journey of, call it digital transformation, like a lot of firms. And, what you were talking about, and we are a Microsoft shop, we're an Azure shop, exactly what you talked about. And when you look at the integration of AI, what they do for us today, and then the development tools and call it the networking effect, by integrating all those things, they're pretty unbeatable. For a small to medium enterprise, pretty hard to say no to what Microsoft is bringing to the market and what they're integrating across, even things like Power BI for data analytics and the like. It's just, they are doing a masterful job from a CEO's perspective, an operations type perspective. There really isn't another player out there who can integrate what they do across all aspects of the business given M365. So, it's a powerful story.
It's a great point, Mike. I mean, a lot of people say, ask me, what do you do for a living? And I'm like, I manage money. But when you really break it down, what we really do is we manage information. If you can't measure it, you can't manage it. There's that old adage, but really what we're trying to do is become more efficient at managing all of this information that we get, figuring out what it means to the business, and then reacting accordingly. And I think Microsoft is firmly positioned to provide that service to companies like us, which will position us great for the future. Yeah,
for sure. Well, thanks for that, Dave. So looking forward, what are the kind of things you're watching? What are you keeping your eye on?
Well, I think, obviously, we're in a tumultuous environment, like no question. So I think for information technology, the focus remains on this whole AI monetization opportunity. I think if you look at the hyperscalers, so the big cloud providers, they're targeted to invest, call it between $2 and $3 trillion in this opportunity over the next 5 years. They got to get an ROI on that. So we got to start seeing revenues show up to support that level of investment. Otherwise, these valuations can't persist. Having said that, if you look at the information technology sector, it has been lagging after a couple of good years in 2023 and 2024. So valuations, like I mentioned earlier in the call, are much more attractive, certainly on a relative basis. And the first quarter was good for most of these companies, and they have high levels of profitability. So we're still attracted to the space. And I think that on top of all of that, if you start looking at some of these macro indicators, they're being marked down generally. Like if you look at the U.S., they're being marked down. Like we're looking for essentially slower growth and maybe a little bit higher inflation. And one of the things investors may not realize is, like, when we're in a situation like that, generally you can see investors start to pay a premium for secular growth. So while I frame information technology or put it in the same bucket as industrials, there's also this secular driver as well. And the secular story in information technology can and will be the AI monetization opportunity. So that may be an opportunity to see information technology reassume leadership from a market perspective. And then for the industrials sector, it's really, for me, it's a focus on price cost spread. Like if you think about 2020, 2021, inflation was high, and basically what happened is a lot of the companies that we own, because they've got a good brand, they've got good market leadership. When you're in that position, it's nice. It's a nice place to be. And that's why we gravitate towards those companies, because you can push through price. In other words, if you want to take price, you can take price. You can raise prices because you've got that brand, you've got that market leadership position, and that can help you maintain margins. So, but what we'll have to see is, like, is it sustainable, that price cost spread? Because, I don't know about you, but I'm a little bit fatigued with these prices. Is there more appetite in the market for pushing through price increases? And then if not, how will these companies maybe maintain that price cost spread by cutting costs or garnering efficiency initiatives or benefits in lieu of higher price? And then, of course, one of the things we're looking at on the industrial side as well is just more clarity with regards to tariffs and DOGE. I know DOGE is kind of taking a little bit of a backseat, but there's still a fiscal issue in the U.S. And so we have to see, from a spending perspective and a budgetary perspective, the government always is a big customer to the private sector. And so, we'll see what they're doing from a fiscal perspective, whether we see cutbacks or not, and what the implications are for guidance for the rest of 2025 as we head into a second quarter earnings season, which should happen shortly.
I mean, and thanks for that, Dave. I mean, you think about, as you say, tumultuous is the word. uncertainty. I mean, you think about between Doge, and then you think about this big, beautiful bill in terms of the spend that's being proposed. And it just makes your head spin. It's like, okay, which way are these guys going? And that's, back to your opening in terms of, well, you know what, just stay focused on the quality companies, the quality investments and quality management teams, because they'll navigate through this. And again, per my mantra, I still believe sanity will prevail. I mean, you're saying, the street talked about the taco trade. Trump always chickens out. Again, I think it is going to be, a tumultuous, interesting time. But it's good to know that we're invested in some quality stocks. And Microsoft is an excellent one that you've highlighted.
I was just going to say, it's funny, though, like when there's not a lot going on, nobody wants to talk to me, but when things get difficult, my phone never stops ringing. And so the funny part is like, if you just think about what we do and how you can be successful in this type of market, is just be consistent. Stick to your process, stick to the blocking and tackling that got you here. And for us, for an analyst, a portfolio manager, for some of our business partners and our clients, it's just nothing changes. Just stick to the plan. In fact, if I look back at the performance of our core picks during the tumult in, call it the lead up into April, they outperformed. And then as we saw sort of these tariff clouds, start to dissipate, they participated in the upside. So overall, I mean, I think we're in a really good place. And if we continue to, select and focus on good companies with these hallmarks of quality that we try to pick for our clients, and try to think about like the risk perspective from actual capital loss perspective, we'll do good things for our clients, and nothing changes. And there really never is a good time to invest. There's always something. There's always something in the background. It's valuations, it's deteriorating earnings, it's geopolitical tensions. It's there's always something. So if you want an all clear signal, you're probably never going to invest. So
and when you say that, never a good time. And actually, when you think about it, when do people really invest? When the market's hot. And this is back to, your opening comments about, but you got to look at the price. What are you paying for these things?
Exactly.
Right? So, and it's all perception at the end of the day. I mean, we see good times to invest, good opportunity to invest, where we can jump in and leverage some of the, the insanities in the market. Sometimes things are overpriced, sometimes they're ridiculously underpriced. And, yeah. All right, Dave, thank you so much for this.
Yeah, great. Thank you very much, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor at your accounting firm, or chat with your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.